Hello, everybody. Welcome to Investing with IBD, sponsored by MarketSmith. Today is April 15th, 2020. And in the pre-pandemic world, this was known as tax day. But of course, now in this pandemic world we live in, it's just another day at home. I'm your host, Arusha Pierce, and with me today is Boboch. She is a portfolio manager and market strategist at Roppel Capital Management. She is also the co-author of a book named The Lifecycle Trade. And here's the book that Eve sent to me. Thank you, Eve. Thanks for being here,
You're
Eve.
welcome. Oh, it's my pleasure, Arusha. I'm so humbled and honored to be here today. I've listened to your podcasts before, and you're a great interviewer, so be easy on me. And you've had some just amazing, great guests, and so I'm really glad to join you here today.
That's so cool to hear. Thank you. On today's podcast, we are going to talk about the current market, buying what you know, and then we will end the episode with a few ideas that could benefit after we get out of the whole pandemic environment. So let's get into the current market. And it's amazing how from week to week things can change. The market is in an uptrend, and the character of the market continues to improve. And we're seeing more leading stocks building bases, and some of them are breaking out. Eve, what are your thoughts?
Well, this is certainly an unprecedented time. And before we get started, I want to just say thank you to all those folks out there that are helping people that are sick and are really providing the essential services to all of us that are staying at home and trying to stay safe. So I really want to thank everyone, and everyone stay safe, okay? So
Well said.
I just
Yep.
wanted to, thanks. I just wanted to talk a little bit about the market, as you mentioned. This has been, before this rally, we had this unprecedented waterfall decline. And it was shocking. I mean, I've traded through various markets, bear markets in the past, and this one was really, really harsh. A lot of stocks corrected, just super deep corrections, and it happened so quick, right? I mean, we look back, it's just been a few weeks. So looking at the charts, I go through all the charts on the weekends and during the week, and there's been a lot of damage because basically the economy has been halted, and this has never happened before. So when I scan through all the charts, I see charts that I haven't seen in a long, long time, and that damage is going to take a long time to recover. But yet, as you mentioned, there are some glimmers of hope. I've seen some stocks that have set up during this terrible market and actually have recently broken out to all-time highs. So there has been some strong action over the last few weeks, but it's still going to take time, I think, to repair the damage.
Yeah, and going back to what you were talking about originally with how quick this correction came. And I mean, this was the quickest that I've seen from a nice steady uptrend to just a very devastating downtrend without very little warning. But that being said, I'm sure you feel the same way. It makes me appreciative of having great rules and not being a deer in the headlights and reacting when you start to see stocks breaking down, when you start to see the market go into a correction, all these distribution days collecting. It's just a great lesson and a reminder that anything can happen in the market.
Very true. I was lucky. We were defensive starting in late February. And also I wanted to mention that as I was reflecting for this podcast, I just feel so lucky to have such wonderful mentors over the years. I mean, Bill has taught me so much, as well as Jim Roppel and other great traders as well. And I was reflecting on that, is how did we actually exit the market and get defensive at that time? A lot of our stocks triggered sell signals, and we were able to sideline a lot of this correction. So I'm really grateful to the mentors that have helped me over the years. It's been so valuable. It really has.
Absolutely. Bill, the impact that Bill O'Neill has made on all of our lives is remarkable, and the rules that he really introduced all of us to, they're timeless, and they
Really
continue to
true.
protect us, right? And of course, Jim Roppel's a huge favorite on the podcast, and also has a lot of wisdom to share. So we always love having him on. Now, with some of these sell rules, were you using some of the defensive sell rules in the beginning to help you get out, or were you being a little proactive, also locking in some gains? Because the year started out really well, right? And some of
Right.
these stocks, and you've done this for a long time too. It's like it was always in the back of my head that things are working a little too well. Maybe I should be a little bit more proactive and try to lock in some gains, even though sometimes it's so hard to cash in some profits.
We saw a lot of parabolic moves in our holdings, and so we were selling quite a bit into strength and some on defense as well. But that helped to retain a lot of the profits for the year and helped us sidestep a lot of the decline.
Excellent.
Yeah.
So, Eve, let's get into how you got into investing. And you started out like a lot of us. You just started trading on your own, right?
Yes, yes. I was interested in, I've been interested in the stock market and trading for a long, long time. But in 95, I really decided, oh, I'm going to trade my own account. I'm going to trade stocks. And so I started reading a lot of different investment books and attending seminars. And then I happened upon Bill O'Neill's book at the bookstore. So
Yeah.
there it was. I picked it up and it really, really hit home with me. And so I read it, I reread it many times. And then I was lucky enough to go to my first IBD seminar. This was back in 95 as well. I went out to Florida and had an opportunity to meet Bill O'Neill, and David Ryan at the
That's
time
awesome.
was teaching as well. It was like a one-day seminar. It was awesome. And at the end of the seminar, I still remember this, I got the courage to go up there and introduce myself, right? And
Yeah.
Bill was there answering everyone's questions, you know, and I noticed over the years, he would always do that. He would stay and make sure like the last question was answered. You know, they'd be turning off the lights in the
Yes.
venue and he would be there. Bill is a great teacher and you could tell he enjoys it. So I remember exactly what he wrote and I still have the book. I was trying to actually find it. I know it's here in my office somewhere, but he wrote, I asked him to write advice for a newbie trader like me. You know, what advice would he give to me?
Yeah.
And he said, buy the best stocks with great earnings coming out of bases. Look at all the
That's it.
great
Yeah.
advice he put into one
Exactly.
sentence.
Exactly. I mean,
That's,
and that's the name of the game right there. It hasn't changed.
yeah, I've always remembered that. And also I wanted to mention the IBD seminars. I started attending just about like every year, if not more.
Very
And
smart.
I was reflecting back in preparing for this podcast. A lot of the people that I associate with now, I met through attending the IBD's like advanced seminars in Santa Monica. So I
Yeah.
actually met Jim Roppel there. I met the team through connections there and through the IBD meetups that I worked on with the IPO research study that I'll talk about later. So it's interesting, like what a small world, and how I was able to meet my network through various seminars, and really thanks to Bill and all the IBD folks.
Yeah, it is pretty incredible, and I've seen it, and I've heard it from a lot of others too. Just how tight the community is, and once you get in that network, and it's pretty cool how well everyone stays in touch, especially these days now. And the project that we'll talk about in the second segment, that's a perfect example of how you guys all stayed in touch. You did the study, and came up with a really cool book on top of that.
Yeah,
So
I met Jim. I think it was like 2006 in Santa Monica. Jim
was
Roppel.
that the master's program?
Yes, I think it was
Okay.
like the advanced level 4 at the time.
Yeah.
And at the time as well, I was working for the Federal Reserve. So I had a great career with the Federal Reserve. I worked there for around over 20 years.
Wow.
And had various roles there. Had a chance to meet with people, talk to them and work with them across the country. and worked through some of the events. At the time I was at the Fed, we had 9/11, the financial crisis. So
Wow.
learned a lot from all of the people that I worked with. And at the time, I was also, I've always had a passion for the stock market and trading. And Jim Roppel was starting a second fund, a growth equity fund. And he asked me to join him. That was in 2011. So I joined him as a portfolio manager in August of 2011.
Yeah.
So it was interesting because at that time, it was nothing like 95. When I started in 95, I was a new trader and it was a very strong
Perfect timing.
market.
Yeah.
It was perfect timing. I couldn't have timed it better, right? And so pretty much everything I did kind of worked out. Well,
right.
Little did I know that's not the way it works. The market and trading is much more difficult than that. But of course, I was doing very well because the market was also helping out. It was the strong market. But when I joined as a portfolio manager, I remember the exact day, and the market, the NASDAQ closed down 5%. And it was going to be a choppy, severe downtrend. And it was very difficult to trade. So, I learned a lesson. I did get chopped up a bit when I started.
Mm-hmm.
And the lesson I learned is, there's times to be very aggressive in the market. When it was a strong market in the late 90s, it's very different from the 2011 market when it's time to really step to the side and kind of watch the action, wait for a good pitch, because it's very easy when the volatility is very high to get chopped up.
Yes.
With the stops that you use, you try to get positioned, and after a while, it's death by 1,000 cuts if you try to trade too much in that type of a market. So it was a great lesson for me.
Yeah, and a lot of times the most dangerous market is not the downtrending market; it's a sideways choppy market, because you're going to get chopped up. And
Right.
if you don't listen to the market, if you don't listen to the feedback and pull back, and maybe even just play with smaller positions, you're going to lose a lot of money very quickly.
Very easy to do. Yeah. So, even with this more recent follow through day, what I usually do is wade back into the market.
Yeah.
I'm not going to be very aggressive right off the bat. And the intraday volatility has been so high. So what I typically do is reduce the position size and widen the stops a little bit. Otherwise, It's very easy to you could even be right and intraday get stopped out of a new position. So I've waded back in. I have some new positions that over the last few weeks that have been working, but I'm waiting for more feedback before I would get more aggressive, because we're not sure, right? This has been an unprecedented event. We're not sure, the pandemic has been a black swan event, and we've learned that anything is possible in the market, and no one knows really, is this a counter trend rally or was the bottom put in? No matter what anyone says, no one really knows for sure. So what I do is, watch the action, watch the market action, watch what the stocks are doing. Are the indexes regaining the moving averages, or are they providing resistance? What's the breadth? And most important is just the feedback from the test new positions, the smaller positions.
Definitely, yeah, and so there have been reason to have exposure in the market and to get that feedback, but you don't yet, like you said, you don't want to be ultra aggressive at this point, because it's still a lot of uncertainty and still plenty of volatility.
Right.
So the market is back in an uptrend, and we potentially could be starting a new bull market. And so make sure that your watch lists are fresh and play with some more smaller positions to get feedback in the market. Let's take a quick break, but when we return, we are going to talk about the importance of buying what you know. Stay tuned. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks.
who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020.
Eve Boboch is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Eve, let's go over the importance of buying what you know. And this is something you've been using this concept for a long time. Why don't you walk us through some of the reasons and how you do it?
Well, I'm an early adopter. I like to test products of the companies that I'm considering investing in. I've just found that it's really helpful to have that firsthand knowledge.
Mm-hmm.
I do a lot of research as well and a lot of reading, but nothing really beats having firsthand experience with the product and service of a company that I'm considering.
Yep.
And I think that's why I've always been interested in early life cycle stocks and IPOs, because I am an early adopter and I like to test the different products. I'll just tell a couple of stories.
Definitely, please. Yeah.
It was a learning experience for me, and I'm going to go all the way back to 1998. And for those of you that weren't trading in the late 90s, it was a wild time. eBay came out during a crazy market, and it formed a quick, deep IPO base, and it shot out of there like a rocket ship, and advanced unbelievable numbers. Right? So this was 1998, the late 90s, when anything tech was moving.
Right.
And I had thought that the company could do very well. That was my personal opinion. And I started reading and researching, and I read an analyst report that started questioning eBay's entire business model, saying, they have no moat around their business. Competition is just going to, really be a problem for them. There's no way the company can be successful.
Yeah.
And, I kind of discounted it, and I still, I had the stock, and but I ended up not handling it well. And I can tell you, probably in the back of my mind was what I had read, that impression of I just didn't have the right conviction level to stick with the stock and didn't handle it well. And so kind of fast forward now to, I think it's 2007, was it, when Apple launched the first iPhone?
2004. Right.
Oh, was it 4?
Oh,
okay.
no. Oh, 2000. My bad. Yeah, 2006. Late
Okay.
2006. They did the iPhone. Right. Yeah.
Okay. So they launched the iPhone, and I was reading another analyst report because I do a lot of research and a lot of reading, and the analyst said that the iPhone is a terrible product. It's not a very good phone. You can barely hear the person on the other end.
Right.
And I was just, this time I had the phone in my hand. So I was early in getting, the first iPhone. And so I knew the report was wrong, because this wasn't a phone, this was a computer in your hand. And that particular analyst just didn't get it. So I think it's really important for me to understand the product and the services very well. And it's in addition to all the other research, the fundamental and technical research, but this little piece I think helps with conviction in a company, because there's going to be times when a trader's conviction is tested, right?
Mm-hmm.
There's going to be times when the stock pulls back, or if you're sitting through a base, or if some negative news headline comes out. So I found this as a really helpful exercise to make sure that I keep up with the companies that I'm thinking of investing in. And another example is Tesla.
Yep.
So I was one of the first to test drive the Model S. I'm thinking that was launched around 2012, and then later on, after a while, they offered test drives of the car, and right away I knew this was really a game changer because the car was amazing. I mean, the car was more a computer on wheels, right?
Yeah, yeah.
And it was just, you hit the accelerator, it took off. Um, so the firsthand experience helped me when all of the negative press came out about Tesla. And I don't know if you remember, but it was like, they would be talking about fires, the cars
That's
are
right. Yep.
burning up, people are
Yep.
dying in the cars.
Yep.
Um, I, I don't know, they seem to blow the negative news out of proportion.
Right.
And so even when I would talk to people, if they had not actually firsthand experience with the product, all they could tell me is that, oh, are those the cars that catch on fire all the time? And so really the firsthand experience was important for me. The other thing, when they launched the Model 3,
Hmm.
I actually went out there the day when they were taking registrations for the Model 3, and I was out at Oak Brook Mall, and there was a line wrapped around. Remember how the Apple store would have lines for the iPhone
Oh
launch,
yeah,
like
all
all
the
the way
time.
around through
Yeah.
the mall?
Yeah.
Well, this time it was for people putting down $1,000 on the Model 3 on a car they hadn't seen before.
It's
And there
incredible.
were lines like that wrapped,
Yeah.
wrapped
Yeah.
around the mall. So I was in awe of that. I think that day they took something like 180,000 reservations for the car. It was unbelievable. And then probably it was like a few weeks later, or maybe a month or so, they had almost 500,000 people that put down $1,000 to reserve their car. So all of that, I think, helped me handle the trades in Tesla more effectively, and balance out some of the negative media coverage.
Yeah, and that's a really key point, especially I think that the first thing that you were talking about with the analysts. The analysts are really smart people, but they're focusing on certain aspects of it, and it's really hard for anyone to truly understand what these companies can do. Sometimes,
Right.
right? Even like when the iPod came out, I remember seeing, I was like, who's going to pay $400 for this digital music player when you could get like the Archos music box like for $100? Well, a lot of people
Right.
apparently were willing to pay $400 for it. So it's really hard to understand that, which is why if you have that story, then you follow the charts, then you start seeing the sales and earnings coming. Now you start putting the pieces of the puzzle together.
Exactly. Yeah, it's so helpful. And one of the things, I was also influenced by the works of Peter Lynch,
Okay.
and he wrote about just the concept of looking at what the younger generations are interested in, the types of brands they like, where they shop, is just kind of a starting point for researching some potential high growth future high growth companies. So that's another influence on me. And yeah, I think you and I were talking earlier. We both started Amazon pretty early, right?
Yes. Yeah. 99.
Yeah. So I looked at one of the banners on when I was on Amazon the other day, and yeah, I couldn't believe it. But it was 99. What's interesting is I was asking, I would like make it a habit to ask every year, ask people if they've shopped online, and it's taken a long time. It's been decades, and slowly over time people are buying more online, and of course now in this situation they are as well. But those types of disruptions take time to occur. And the other product was the Alexa, which I bought early on, which
Yes. Yes.
really helps understand the company and where it's going. So just my key takeaway or my thought on this is that nothing beats the firsthand experience with companies and products. There, I do all the other research as well, the fundamentals and the technicals, and read the reports, and there are some takeaways from that. But when you need the conviction in the company, the firsthand experience is very helpful.
Yeah, and it doesn't necessarily even have to be technology companies.
Right.
Restaurants, right? Restaurants, you're always gonna. It seems like every bull market is gonna have a new kind of innovative restaurant. You have Chipotle that had lines out the door, or
Right.
Shake Shack is a more recent one. that there are lines out the door there too, right? So you always want to
Yes.
keep your eyes open, and because you may stumble on an idea that way instead of through a screen at MarketSmith or an article that you read. You just may just actually just see a long line out the door and pull out your phone and see if it's publicly traded. I've stumbled on a number of ideas like that.
Right. And
So
I remember Bill saying that he owned one of the grocery stores or a grocer, and he
yeah.
would go by and drive by and he'd count,
Oh,
real quick how
pick and
many
save.
cars. Yes,
Yeah, he'd
he'd
go every
count how
day
many
and
cars he'd
count
see.
the number of cars in the parking lot there. Yeah, so and that he held pick and save for 7 years because it just kept
Amazing.
working. Yeah. So
And
let's
through the
get
bad markets too, right?
yeah,
Didn't he
yeah.
hold
He
on
held through
through?
a bear market, which is remarkable. He had so many shares of it. I think he had like maybe 4% of the company shares available. He had a monster position in it, but
Yeah.
yeah, he held through the bear market. But even then, he said that he drew a line in the sand. He was up a huge amount, but he drew a line in the sand and said, okay, if it comes down and starts to get below this price, I'm gonna have to start selling. And it came within $1
Wow.
of it, and that was it. And then it took off and went on to another double or triple from there. So yeah,
Yeah, that
that's the
line in
ultimate.
the sand is important.
Very, very important. Now let's take this the next step, because you mentioned about your interest in IPOs and finding newer companies, and so you co-authored a book named The Lifecycle Trade. And so you walk us through a few of the concepts that you and your fellow co-authors discovered when researching super growth stocks and IPOs.
Okay, let me do a shout out to the team. It was a
Yes.
team effort, and we did an IPO study. We actually worked on that for several years. Really spent a lot of time looking at the IPOs over the last couple decades and all the super growth stocks, and worked very, very hard for several years. And it was great fun. We had great fun working together. So a shout out to Kathy Donley. Kathy,
Hey, Kathy.
thank you. Eric Kroll and Kurt Dale. It was a great team. We learned so much. We never thought it didn't start as a book.
Yeah.
It started as really a question. And the question that we had was, is there a way that we could tell early in a stock's life cycle that it's going to be a super growth stock in the future? Are there tells early on? And so our research took us different ways, but in the end, we were very heavily influenced by Bill O'Neill. And I remember Bill used to say, I think it's in his book, if you want to learn about fish, study fish,
Yes.
watch the fish, right?
Yep.
And what we did was, in our case, we took a deep look at the IPOs and the super growth stocks and how they behave. And we were really surprised by the results. We didn't expect it. And I'm not going to share all of them today, but just because of time, but a couple of the key findings is that stocks have a life cycle, and there's 3 different main phases. I don't know if we can put up the PowerPoint at all.
Yeah, we can put them up
Okay.
afterwards. So the life
Okay.
cycle phase here. Yeah. So walk us
Yeah,
through the
there's
few
3
phases. Yeah.
there's 3 phases. There's typically an IPO advance phase. So this is a short-lived phase. So a stock comes public and it may have, a short advance. Not all of them do. Some just fail right away, and we'll talk about that type of pattern in a little while. And then, so let's say it has a short IPO advance, short-lived, and then it has a sideways to down corrective phase, and that could be months to years. And what's happening here is this early investors are taking profits. It's putting pressure, and short-term traders, it's putting pressure on the IPO.
Mhm.
And you can see from the chart, the action is sideways to down for months to years. And that we call an institutional due diligence phase. At the same time, longer term investors and institutions are researching the company and deciding whether they're going to accumulate shares.
Right.
And then if
And so that's
a
that's usually like a couple of years or so, right? Maybe 18
right,
months
yeah,
to
it could
2
be
years or so.
yes, usually. Sometimes it could be a little shorter in
Okay.
months, but that's a typical time, yes. And then if a company is institutional quality, then it'll have an institutional advance phase. And this is usually the longer phase where longer term hold rules and sell rules can be used. Because if you look at the IPO advance phase on this particular example, it's short lived, and shorter term rules work better. More offensive types of sell rules work better in that phase. And what we found also is that a lot of stocks, after they IPO, go through the IPO advance phase, will undercut their first day trading day low. And that happens very quickly. So a majority of stocks will undercut their first day low within 3 weeks. And we studied, decades worth of stocks that went public. And so we were pretty surprised by those results.
Yeah.
Because a lot of times people want to jump in right away. So you have the FOMO, the fear of missing out, right? And this could affect inexperienced investors, but even experienced investors can get caught up in the hype of a new IPO. And Facebook is a great example. So Facebook IPO'd in 2012, and it was to so much hype. I don't know if you remember, but I don't know. They showed people that were like remortgaging their homes to try to get
the
a lot
IPO.
of pre-IPO
We received a lot of calls that I have never seen a more hyped up stock, and had as many calls of people asking me, hey, how do I get Facebook shares? And it was in the back of my mind that how could this work? If the normal person wants it to work, there's no way it could work, right? The market
Right.
always goes against the kind of just the common person.
Exactly. It was a real contrarian signal. And also, investors that requested shares were getting their allotments,
That's
which
right.
never
Yes.
happens.
Yes, exactly.
So when you see those types of signals, it's not going to be pretty after the stock goes public usually, right? Those are contrarian. So Facebook went public and almost immediately started to decline. And so, investors that bought, pre-IPO or tried to get in first day because they were really fearful of missing out on this great growth story were probably really hurt. It took months. I don't know exactly.
Well, it got cut in half, I think. It IPO around 40 and was down to 20, even less than 20, I think.
Right. So it took a long time. You could see the base there, and it's going through. So this was an IPO failure. There was no advance. It almost instantly started declining. And then it's going sideways, while institutions research whether they're going to make investments for the long term. So the short term traders were selling out. And it took quite a while to start its IPO advance phase. And it did because, obviously the fundamentals started improving. The story was a growth story, and institutions started accumulating shares. So it had a long advance and, turned out to be a super growth stock. But investing day one would have hurt a lot of people, or even at the IPO price. So one of the key findings, the myth is that you need to buy right away, buy on day one to make money. That's the time to get in. The fear of missing out. That's a big myth because a majority of IPOs will undercut their first day low within the first 3 weeks. So, it's better to wait for some consolidation. And then remember that even the IPOs that have a short IPO advance phase typically eventually undercut as well. So it pays to be patient.
Definitely. And it pays to know what you know in the market, and also the behavior of stocks during different phases of their life cycle. So here's her book. Here, all 4 of them, the Lifecycle Trade. definitely take a look at this book. There's a lot of research done. The more familiar you can get about these newer stocks, the better prepared you will be for some of the next great stocks. Coming up next, we will discuss a few ideas. Stay tuned.
I'm here with Scott St. Clair, and Scott is one of the senior product coaches at MarketSmith. Now, Scott, we've both been doing this for a long time, and we know that investment research takes a lot of time. There's so many factors that you want to look into to try to figure out whether this is a stock to buy or not. Quarterly earnings, huge sales growth. Hey, are institutions buying it? The list goes on and on.
Yeah, it's a common question. I hear it all the time. I don't have time to do this work. So you don't have to spend that much time. If you have a tool like MarketSmith, we do a lot of that work for you. Right there on the chart, earnings, sales, group strength, institutional sponsorship, like you just mentioned.
Right.
It's all there in the chart. So it allows you to make a decision much easier.
Yeah, and the beauty is that we have in-house analysts that go through the SEC filings. They pull out those numbers, and they put it right on the MarketSmith chart, and all you have to do is analyze them.
Yeah, I couldn't imagine having to go to the SEC website and look at the income statement, et cetera. That sounds like a lot of work.
Yeah, and that would take hours and hours, and in that time, you can go through hundreds of stocks and find the best ones. So don't miss out on a big winner because you don't have enough time to research it. For more information, go to investors.com/podcast2020.
We are back with Boboch on Investing with IBD, sponsored by MarketSmith. Okay, Eve, let's go into a few ideas and also some trends that could do well in the post-pandemic environment. So let's start off with the trends first.
Sounds good. I've been doing some thinking about how we're going to work, live, and play post-pandemic. And what I was thinking about is how some of the trends that we've been seeing develop during the pandemic may continue on in the future. And I'll just mention a few of them, but I'm actually spending a lot of time thinking about this and then looking at which stocks would benefit most and thrive if these trends continue. So it's one way that I'm screening and looking for new ideas for the future. So the three trends that I want to mention today are working from home, and pretty obvious, and the need for the technology that supports it. So, less time out interacting in big groups, so meetings, webinars, working from home, school from home, and also working out at home, because versus possibly going to the health club and interacting with lots of people. Because again, I think that just the solution to the pandemic is going to be happen over time and be more of a marathon than a quick solution. So some of these trends may continue in the future. And the third one being online shopping and delivery services. I mean, some of these companies have been very creative during the pandemic, where you can order things online and just drive by and they run out and give you what you've ordered. I mean, some of these models may continue in the future. So that's also a trend that I'm looking at. And then what I start thinking through is, and there's a fourth one too, is telemedicine. I'm not going to talk about particular stocks.
That is a huge growing trend now, right?
It's a huge one with the online medical visits.
Yep.
So I won't really talk about stocks for the sake of time under that category, but that's also another one that I'm looking at. And so I was thinking about, what stocks will thrive and do best in these types of trends. And maybe we could talk about a few of them. I want to mention, though, at this point, remind everyone that nothing I say is really intended as investment advice to buy or sell any securities. And I do want to mention, of the stocks that we talked about, exactly which ones we have positions in. So we talked about Tesla. We do have a position in that. Zoom, Peloton, we'll talk about these, and Chewy. And then we did mention Amazon. So those are all positions that we currently hold.
Yeah, and I have positions in most of those too. So we're on the right track. We're thinking the same thing here. So let's get into the first stock and for the post-pandemic trend, and that's Zoom, right? And this is the work from home trend. And let me pull up the chart for this. And let's see.
Well, if you've been staying, if you have stay-at-home orders, you know that a lot of people are using Zoom. There's Zoom quarantine parties, remote
Yeah,
parties. There's
yeah,
collaboration where work teams are using Zoom. Kids are using it for remote learning. The company basically, I mean, we're bringing, I believe, right, where you're using Zoom and bringing the podcast to you
that's
via
right.
Zoom.
Yep, yep,
So it's getting a lot of use. The visits have increased, and the use of the app has increased tremendously during the crisis.
that's
And
interesting.
when I think about the future, that trend, might continue.
Yes. Yeah,
The
I think
apps,
everyone has, and we definitely here at IBD, we're using Zoom left and right for meetings all the time, and we're all seeing how efficient it is. You get down to the point, you're in, you're out with these meetings. You're not, wasting a lot of extra time. So I wouldn't be surprised to see us, even once we all go back to the office, start using that more instead of all meeting always in conference rooms, and things like that. So we've seen the benefits of, obviously you mentioned with the podcast, and you can clearly show the chart. We're using it. Everything works really well. Now there was some negative stuff though that was going on with
right,
Zoom over the
right.
last few weeks, right?
Security and privacy. So there's definitely headline risk with this company, and it's had, quite a run as well. So there's always risks associated with, with any stock. So on the negative side, some of the headline risk has really made the name volatile. And I just wanted to talk a little bit about the chart. So you have the
Yeah.
chart up there,
Yep.
right?
It's,
So let's look at it from the perspective of the phases that I mentioned
okay.
earlier.
Yeah.
You could see, and this is a daily chart, right, Arusha?
This is the daily chart. Yep.
Yeah. Okay. Awesome. So you can see how the stock came public and then had its IPO advance phase, and it was,
Right.
pretty short-lived, but it had a nice pop. It had a nice move. And then what we talked about before, now it starts going into like a corrective phase. And this is the institutional due diligence phase where, some of the investors are taking their profits and the stock is undercutting that whole advance.
That's
So
right.
that's pretty normal. We see a lot of IPOs that have this type of action. And in the past, this surprised us because I wasn't aware of this in the past and how many IPOs have this type of action. And so it's important to keep it on the radar, right? And
Yes.
sometimes you
Absolutely.
could easily lose the stock in terms
That's
of
the hardest
having it on
part.
your
Yeah.
radar.
Yeah. It's you forget about it. I mean, this base here was 168 days. So essentially a half a year right here. Uh, Very easy to have it fall off the radar if you're not keeping it on a larger watch list, because why would anyone really want to, keep watching the stock as it's just going through a downtrend?
Right, exactly. I'm just bringing it up back here so I can see it on my monitor. And so you could see how it consolidated for quite some time
Mhm.
and then finally moved out above that 107 or so level.
Right.
That's what we refer to. I don't know if you saw it on our phases, but we call that the turbulence zone. And that's just a previous high where the stock typically might have a problem there. It may like rebase, it may shake out a bit, just when it kind of goes back to its all-time high there. And you can
Yeah.
see there was some turbulence there.
There was
And
definitely.
yes, and then it tested the 10-week moving average, and we'll see what happens from here. We'll see if it can have a sustained institutional advance phase.
Yeah, and
But
the test of
that's
10-week moving average right here was, that's when all that security stuff was coming out, and that was a pretty brutal test too. It was like down like 26% off its high,
right.
so pretty vicious. But as you said, now we'll see how it goes. A pretty strong move out of it. Earnings and sales are great for the stock. It is a newer stock, so those are always positives too.
Right. And because it's starting what's potentially the institutional advance phase, that's where we found that possibly some of the longer term or midterm types of sell rules might apply. But you could see where it had its quick IPO advance phase that shorter term, more offensive rules would have worked out better in that phase.
Excellent. So let's go to the second stock, and this is Peloton, ticker symbol
Yeah.
PTON. And
I think you were telling me that you have one, right?
Yes, I just got it yesterday. Yeah, so when Eve and I were talking last week, I ordered a Peloton a month ago, and it was funny because I was kind of debating, but I was like, I don't know if I want to necessarily buy this really expensive bike. And so I was looking on Amazon, I found another option that looked pretty good. It was like maybe $400. And I was like, okay, maybe I'll get that. Let me sleep on it. By the time I came the next morning, everything was sold out. All the bikes were sold out.
Wow.
And so I thought, okay, I'll get a Peloton. They'll probably have those. Nope, I had to wait 4 weeks and so after that, after I saw the demand when I was trying to contact them through customer support and all this kind of stuff, and they had a message on their site saying, we can't move up the dates, all this stuff, there's huge demand. So I went and actually bought the stock at that point. And now it's not your traditional kind of buy point, but I was like, it's pushing a lot of people off the fence who were considering a Peloton. And it's not necessarily the bike, it's more that community that really kind of surprised me. So yeah, I finally rode it a couple of times right now. Obviously it's a really good bike. And I you can see just that where it tracks all your stats. You have this whole community. There's hundreds of classes on it. So and it's right here. Like during lunchtime, I just went and rode the bike for like a half hour before doing the podcast right now. It's I can see why people get addicted to using this bike.
See, so you're doing that research,
Exactly.
that firsthand research, and I could just tell, how excited you are about the product.
It's yeah, and I was one person who never considered this a few months ago too. But it was all, it was always just kind of there. What's funny, and I'll give a little shout out to Ryan Davis, who's Cubby Bears on Twitter. He's been talking about.
Ryan.
I know you know Ryan, right?
Yeah.
And he's another one
Hi,
who's hey Ryan. He's another one who's really into IBDs, come to the Masters program a lot. He's been a great investor for a while, and he was on Twitter talking about Peloton way before it went on this monster run that's gone lately. And I went on there and I said, don't give my best idea away. I don't share all the good ideas. So yeah, Ryan's very good, and he picked that up, and so he was you should follow him because he's sharing some really good ideas too. But it's just, and he has the bike too, and so I saw him talking about the bike, how he's riding it, every day, like for 30 to 45 minutes, and he's pretty enthusiastic. So that was another thing. Someone I knew that was just kind of pushing me off the fence too, to do it.
Right. Yeah, it makes a big difference. And so for people too that maybe don't want to right away buy the product, what's interesting, I tried to choose companies where it's easy to test the product. So Peloton lets you go right into the store. I tested both the treadmill and the bike. They let you actually do a workout in the store. So you could kind of experience what Arusha's explaining here. And again, it would give you that firsthand knowledge of the company. So that's very valuable.
And going off that store too, Eve, that really reminds me of when Apple released their stores back like in the early 2000s or so. And it actually gave people an opportunity to go and touch the Apple products, because at that point, Apple was kind of dead in the water. And then, but I remember the one store I always wanted to go to when I was in Boston is the Apple store. And I would just go out. It took me years before I finally started buying Apple products, but they're always the coolest products. Now, almost everything I have is Apple. It's really just touching, feeling, getting to know it. And that's brilliant with Peloton, having them ride the bike and seeing how cool it is. And then people realizing, hey, you know what, I could get excited by watching these classes or whatever.
Yes. And one thing that's interesting with the Peloton, you could also get a subscription, I guess, to their classes, all different types of workouts, and use it with existing equipment. So if you don't buy their equipment, you can also get like a monthly subscription. So it's interesting to note like all the different avenues and products they have. Well, a little bit, should we go through their chart a little bit?
Yeah, let's go over their chart. Yep.
Okay. All right. So Peloton also had this quick IPO advance phase, which again, faster rules would have worked better there, you can see. And then it corrected severely with the market.
Right.
and it's not, it's been basing for a while, and today it had a real strong day, and it's looking at trying to clear some of these key levels, and then we'll see how it acts, around the 37 level, which could provide some turbulence if it follows the patterns that we saw in a lot of IPOs.
Yeah, it's almost a really kind of big double bottom that
Right?
it's put in here, and so
Very
if you're
severe,
using
right?
that, yeah, it is very severe.
Which
And
makes
if
sense because of the market.
exactly, exactly, and that is one key that when you're in bear markets, you have to take that
Mhm.
into account if these bases are a little bit more volatile. But it did pass. If you're
Right.
using a double bottom out of this, it did pass that buy point of
Mhm.
34.60 plus the 10 cents, 34.70. The other thing, and you mentioned this, Eve, is it undercut the low of its IPO base too. Shook out
Right.
more people only for a few days, and that was kind of the
Mhm.
first indication that surprised me, is that came rocketing back too. It's like all of a sudden there are a lot of people happy to scoop up shares at this time.
Right. And if you go back, that's an excellent point, Arusha. And then if you go back like to the first day it traded, see
Yes.
how quickly it undercut that first day
Yes.
low as well.
That's true.
Anyone that
Yeah.
tried to buy there.
Yeah.
So yeah, it's really shaken out several times there. And I loved your point about the bases and what they look like when we're in a severe, correction or a bear market, because the bases are not going to be that pretty. And
R-
that's important to keep an eye on.
Yep. Yeah. It's always perspective on the market. Yet another thing that we all learned from Bill
Right.
years ago. Okay, so let's go to the third. Now, for Peloton, the other thing, their sales are very, very consistent right here. It's just one of these companies that hasn't come around with earnings, so obviously that's a big negative to it, but worth keeping an eye on it. They'll report probably in the next few weeks or so, also. So something to keep an eye on, but it is going to be more volatile because it's a younger company with no earnings. And the final stock is Chewy, CHWY, and here is it's pretty amazing with pets and uh, how much people are willing to spend. And this has been a trend that's probably been growing for the last 10 years. People are just willing to spend a huge amount of money. I have pets that spend left and right for them. So this is yet another company that's come out. What do you like about this company, Eve?
Well, it's, as you mentioned, it's an online pet food store, and it also sells medicine for pets, and not only cats and dogs, but a whole variety of pets,
Oh well,
horses and reptiles. And so they're really providing a service where you can subscribe and have food delivered directly to your house. And I think they're probably benefiting from stay-at-home orders where people want to interact less in retail establishments.
yep,
So this is another stock that's very easy to test out and get firsthand experience with. So, I loaded the app, and they have an app, and you can easily order your pet food and then set it up to just auto send to you on a certain schedule. So
yeah,
again, it might be a stock that benefits from that trend of people wanting to shop more online, get things delivered, and then when once people get into habits, they tend to stay with them, right? So have we changed our habits during this pandemic? And some of them will say, wow, we like these. These are making our life easier. So this fits that trend of online shopping and delivery. This is a classic example as well of a pump and dump like Facebook. So if you look at what
oh,
happened to Chewy when it went public, it
yep,
almost immediately started going down.
yep,
So people are underwater. It's consolidating and going through that institutional due diligence phase for a while, where people are taking profits, and then institutional investors are thinking about and researching whether they're going to take a position in this. So now it's actually made new highs, but again, the turbulence zone is that previous high. So right around the 41, a little over 41. It could start getting some turbulence here. It did when it approached it before.
mhm,
Sometimes when stocks power out, they can do that as well, but most will find some level of turbulence and pullback or base building when they approach or come very close to new all-time highs. So we'll have to see whether it can continue an institutional advance phase here. Some of these are thinner names, less liquid. And also, one thing I want to point out is, IPOs during a bear market can be very risky. The volatility, I think you mentioned that, Arusha, can, just intraday can be severe. The ranges can be very, very large. So it's something that typically, I won't have many IPOs in a portfolio. If I do, they're smaller positions so that I can withstand the volatility. And I want to see the market start to turn because these are high risk names. And what happens is during a bear market, the illiquid names, higher risk names, it's kind of a risk off scenario. So that's something, just as a caution, we're talking about newer names that don't have as much history and they have to be watched very, very closely.
Definitely. And this is yet another company that doesn't have the earnings just yet. And so we'll see how it ends up working out. But he brings up a good point here where we're in maybe the beginnings of a bull market, or maybe we're still in the bear market. We don't know. And so we have the luxury of really picking and choosing our names, and we have our choices right now. So just pick a few and see how that happens. So a lot of times with these more volatile, younger companies, I might not try them as much, or if I do try them, I'm going to go in a lot smaller there. So Eve, why don't you recap some of the key points that you wanted to share with the listeners today, and that they should take away from this podcast?
Okay, thanks, Arusha. Just 4 main points that I wanted to try to get across. And the first is really the importance of doing your own research, understanding the products and services of a company firsthand really makes a big difference in being able to stick with a position in a company through some turbulence. So that's important. And, watch the Peter Lynch principle is watching where the younger generations shop as well. You can get ideas from them on companies to further research, and be really flexible. This is something that Bill taught me. He is so flexible with the market. Right. So he would always adjust to what the market was offering, and be able to go from a bearish stance to a bullish stance based on what he saw very quickly, and vice versa. And so what I wanted to try to get across is just the importance of the market and being flexible, watching what the market is actually doing. These are all concepts that Bill has taught me over the years, and knowing when to press up in a strong bull market and knowing when to step aside. I'm an intermediate growth trend trader, and in these severe bear markets, it's best most of the time just to step aside and, cash is a position, watch what's happening. And then, I typically wade back in. So not too aggressive, because we never know if it is actually the bottom or if it's a strong counter rally. And one of the other points is really the importance of finding mentors and a great network of successful traders to communicate with regularly. I've learned so much from Bill O'Neill, from Jim Roppel, and also from the teachings of Peter Brandt, Dan Zanger, Jack Schwager, and Dr. Brett Steenbarger from a trading psychology perspective. All of these people have really contributed so much to my learning process, and I want to thank them all. But I wanted to make sure that everyone understands that I think experienced and inexperienced traders can really benefit from seeking mentors in this type of a network. And then lastly, just learning how to identify and handle super growth stocks. And this is really doing research. Something that Bill told me, it always really hit home with me. And he said, your job as a trader is to find the next apple, not only to find the next apple, your job as a trader is to find the next apple and handle it well. Yes. And the whole research study that we conducted was really around that, is really understanding what's the life cycle of these super growth stocks, what type of sell rules work well, how is it best to handle them in their different phases. And so that's one of the key things is, and we really try to put all of our findings in our book, the Lifecycle Trade, and share it with others because it helped our trading so much. So we wanted to share it with everyone else.
Perfect. So once again, the book is the Lifecycle Trade. You got a nice little glimpse of how she's analyzing these younger IPOs. And and that's an important part, knowing where you are in the trades and what phase you are, so you know when to push it and when not to. So thanks, Eve, for joining us today on Investing with IBD.
Thank you so much, Arusha. It was great fun.
Next week, we will have Kirk Duplessis on. He is the founder of Options Alpha, and so we'll talk about options and how you can use that in the stock market too. That's it for this week on Investing with IBD. I'm Arusha Pierce, and thanks for listening.